The S&P 500 is a fabulous market to invest in, but it can be difficult to stay invested when you see a sea of red like this and you worry about further declines in the days to come. In this video, we're going to look at a good way to stay invested in the S&P 500 and keep it as a key investment in your portfolio. One important thing to do is to stop reading articles or watching videos that aren't really any help to you in your investing journey, and they keep telling you things are overpriced when actually it's a fabulous long-term market. For US stock markets, you get quarterly reporting, so that's a lot better governance than we have in the UK, and businesses can be taken over, which is unlike what you might experience in China or even in places like Holland, where Unilever wanted to move its stock market listing to try and avoid potential predatory bids from other companies. The S&P 500 in particular is a great index because in order to be admitted, you have to have 2 consecutive quarters of profitability from your core business, and you must be a proper US business. That's where you're incorporated. That's where you're doing some of your trading. But are there 500 truly great companies in America? Hopefully you'll agree with me that the answer is no, and we do have what's called diversification at the bottom end of the S&P 500. On the other hand, 30 companies is possibly too few, and it can trip up people like Terry Smith with Fundsmith, where each error that he makes in his stock picking can be very costly for his investors. People often try and make the argument that the S&P 500 is overvalued, for example, due to things like excessive pricing within AI stocks. But aren't markets efficient? Aren't there trillions of dollars flowing around between companies trying to make sure valuations are fair for that moment in time? Now, if it is overvalued, that's not so bad if you're young and you're constantly adding to your portfolio, because it really won't make much of a difference. But it's not that great if you're, say, older and you've got limited funds left to contribute during your working life, and you may be moving funds out of, say, the FTSE 100 or a Vanguard Life strategy. Here, the important point is to look at a maybe 10, 20, 30-year time horizon, and that helps you to get some perspective around the valuation of the market and how it's probably not that important when you look back from a longer time frame. The solution to staying invested in something like the S&P across market corrections is to apply filters to that index. And then hopefully by focusing on more quality companies within the index, you'll get lower price declines when the market does correct, and you also have more confidence around your long-term holding in the fund, and you won't get shaken out of the position. We're going to look at an ETF that, in my opinion, fits the bill perfectly. There can be a problem with market cap weighting, because the more overvalued a company like Apple becomes, the greater the percentage of the index it takes up, and you can get caught in a bubble where there's a concentration around a few companies, such as technology ones, that have a sort of boom and bust cycle. One solution is value investing, but some companies have never been good value, particularly if they have a strong moat, such as research and development or a very strong brand name. Microsoft could become good value temporarily, but it will soon pass as it regains its growth streak, and a value factor fund would then sell it. People go back 30 or more years to try and prove that the value factor works, but I need consistency and I need performance over a shorter time frame. Another solution is to equal weight the S&P 500. This is more diversified, and you'll be less worried about a company like Tesla missing its quarterly earnings. It also has greater transparency over time, because you know that in 10 years' time, the fund will hold 0.2% of Apple. It's also potentially less volatile. However, at the moment, because the performance isn't that great, I can't quite bring myself to pull the trigger and invest in an equal weight S&P 500 ETF. You could look at dividend weighting, and clearly companies that don't pay a dividend are kind of tomorrow's winners today, but I'm too old and I don't really want that in my fund. There's just too much risk. So with dividend weighting, you can only increase the percentage of the index you take up if the dividend payout rises relative to other companies. And that seems like a good thing. However, focusing too much on dividends and very high yields leads you into certain low growth sectors and potentially yield trap companies with weak balance sheets that are actually borrowing money from the bank to give you a dividend payout, and their capital growth over time is negligible or even negative. Equity returns come from capital growth and from dividends. And my suggestion is to target a return of about inflation plus 3%. So that's about 6% overall. So to deny dividends and just invest in these high growth, rather speculative companies, I think would be foolish. And to solely focus on dividends, you're putting yourself in a position where you need a very high yield, and the sort of companies you're buying aren't that great. So the ideal balance would possibly be 1/3 capital growth, 2/3 dividends, and that's what JP Morgan Global Growth and Income does with its 4% net asset value dividend payout. Or maybe turn it around the other way, go for 2/3 capital growth, 1/3 dividends, and that's pretty much what a quality global dividend growth fund will do for you. If we go to the excellent website justetf.com, we can screen for the best funds. What I've done here is gone to their ETF screener, selected equity, United States, and then I'm sorting on 5-year returns divided by risk. So it's compound returns divided by the volatility. Right at the top, we've got the technology sector, which is maybe not surprising, but clearly there's doubts as to whether it can carry on this fabulous growth streak that it's had, and maybe we need something more diversified. So next up, we've got the NASDAQ, which has a high tech weighting. Then we've got the Russell 1000 growth, which is a little bit similar to the kind of growth emphasis of the NASDAQ. Again, more holdings in there. Then we've got the USA Quality ETF that I featured in a previous video, and I'll put a link to that. The ticker is UC99. Then we've got some socially responsible versions of the S&P 500, but I'm not convinced that the socially responsible filter is a way to get better performance in the long term. So what I'm looking at is the WisdomTree US Quality Dividend Growth ETF. There's 2 variants to it. The accumulating one, which you're better having if you're working and you're just growing your funds and want to set it and forget it, and then the income variant that's paying a yield of nearly 1.5%, and the ticker for the WisdomTree US Quality Dividend Growth is DGRG, and we can see that the growth here is 99%, so it's behind that of the S&P 500, but it's actually been less volatile, and it's had a lower drawdown over 1 year and over 5 years compared to the S&P. So although there's not a lot in it, I think that potentially going forwards, you've got more security behind the filters that this ETF is applying. The WisdomTree ETF focuses on quality, which is a strong balance sheet that has the ability to pay out dividends, and then the growth part looks at earnings that aren't cyclical, so that it's got the ability to sustain dividends over a long period of time. So it'll avoid things like maybe oil companies, where when the oil price rises, they can pay out a lot of dividends, but when it falls back down again, they cut or even totally suspend their dividends. And the expense ratio of the fund is 0.33%, which is kind of high for an ETF, but well below active funds. Next, we look at the website for WisdomTree and we come to the specific page for the DGRG US Quality Dividend Growth ETF, and we've got some research papers that look at what's going on and why this is such a good thing to potentially have. Then we've got a little bit of an overview of the fund when it's launched and how much the size of the fund is, whether it's eligible for an ISA or a SIP, which it is, domiciled in Ireland. Then we've got some data on price to earnings of the fund. So that's quite good because you can track that on pretty much a daily basis. So you can work out when you think it might be relatively overpriced. You've got some other data here around price to book and cash flow, things like that. So that's all very useful. Then we come down, we've got some of the tickers for it. And then we've got growth of some money over different time frames. We've got, okay, this is quite useful, the calendar performance. It's kind of benchmarked against its own index, so it would track it quite nicely. Yeah, but you've got how it does over time. So 2018, quite a lot of funds lost money in that year. 2022, again, yeah, quite a lot of funds lost money there. This one didn't lose so much. Now we've got the top holdings. Microsoft is overweight relative to the S&P 500, as is Broadcom. It's quite diversified. Nvidia, I think, is a bit underweight. We've got quite a good mix there. What I really look at is the sector mix and how diversified I think that is, whether it has the right sectors for me. So we've got hardly any energy, so that's reflecting like the ESG characteristics, so I think that's good. Energy is cyclical, not really great returns. Hardly any real estate, yeah, don't really want that. Utilities, don't really want that. So information technology, number one, that's really good. Healthcare, number two, yeah, like that. Financials, yeah, not so keen. But consumer staples, I certainly like that. And then what you can do is you can view all the holdings in the fund. Click on this and it'll pop it all up, and we come down, we've got 300 in all, so quite a lot, but that's showing some quite good diversification, and we've got 39% within the top 10. The ETF ignores Tesla because it doesn't pay a dividend, and I think that at best the valuation of Tesla is difficult to ascertain, so I'm glad that it ignores Tesla. Looking at the price chart for Broadcom, I'm quite glad that this ETF has an overweight position. To check on the dividend payments of Broadcom, I go to the website Dividend Max, put Broadcom in, and here we've got the annual dividends and how they've grown over time. So this is pretty phenomenal and seems like a great thing to have within an ETF. If we compare the sector mix of quality dividend growth to the S&P 500, we'll see that quality dividend growth is overweight information technology and healthcare, and then it's underweight utilities, real estate, and energy, and also communication services. So it's actually quite ironic that the bottom three are kind of actually quite high yielding, but because they don't have maybe the strength in the balance sheet or the growth in the earnings, that's why they become underweighted. So I'm actually quite happy with the sector mix of the quality dividend growth relative to the S&P 500. Here's the quality dividend growth compared to the UBS Quality Factor ETF with the ticker UC99. And you can see that with the quality factor, it's got a huge weighting to information technology, nearly 50%. So it's not as diversified as the quality dividend growth. And the quality factor is maybe a bit more of a fair weather ETF to hold when you're definitely in a bull market, and then it'll capture a lot of the euphoria that's going on without diverging too much into loss-making companies. So I think for the more longer term, just buy it and forget about it. The quality dividend growth is probably the better bet. So with the right ETF, you'll know what its holdings are on a daily basis. You know what its stats are, such as price to earnings ratio. So you get some real confidence in what it's doing and the quality of the companies that it holds. And I've learned that cash panicking in a market correction just doesn't work, because although you can sell out before the market hits a bottom, it's really difficult to know when to buy back in, because stock markets are so much based around future expectations, and when you think that things haven't necessarily improved, you'll find prices are rising upwards at quite an astonishing rate, and you're not that confident to buy back in, and then you end up missing a lot of the growth of the stock market over the cycle. If you focus on an ETF with full transparency over its holdings, those holdings are in quality companies, then I think you're very well placed to deal with a fund across market corrections and even sharp market declines. And if you make sure that every holding in your portfolio has a specific function, then there'll be no need to sell the fund purely because its price has fallen. So providing you're not greedy and you're not chasing returns, then I think that you can hold a quality dividend growth ETF for as long as it's needed. If you want help putting together a fund portfolio, you'll be interested in my website, ianshadrack.com/portfolio-coaching. If you haven't already done so, check out this ETF masterclass video on the left, or on the right, here's a video recommended by YouTube.